Good afternoon, everyone, and welcome to another webinar of EGADE Business School at Tecnológico de Monterrey. On behalf of EGADE, we welcome you to our panel, COVID-19, the Downturn of a Century. I'm honored to be joined here by three very special guests. David Kostin, who is the Chief US Equity Strategist at Goldman Sachs. David has been with the bank for more than 26 years and is responsible for analyzing and forecasting the US stock market. We also have with us Andrew Goldberg, who is the Global Head of Marketing Strategy and Market Strategy, and advice at JP Morgan Wealth Management. Andrew has been with JP Morgan since 2002 and leads a team of strategists that deliver market and investment views to clients. And Jean-Pierre Lacombe, who will hopefully log in a second to the conference. I think there was a problem with the Zoom connection, but he is the head of markets and research at the IFC at the World Bank. Jean-Pierre has worked for the IFC for close to 20 years, where he provides asset allocation recommendations based on macro and financial analysis to the organization and its clients. So thank you everyone for joining us. We're very excited to have this panel with you and that you could be able to share all your experience and all your views around the markets and the economy. So I would like to get started with saying that we are facing a pandemic that hasn't occurred since a century ago. And it seems like we have a tale of two worlds, where what the markets are telling us on one side and what the economic data is showing. Early in the year, we saw a quick rise in asset prices that eventually led to reaching all-time highs in mid-February. Then we experienced what we call a black swan event that resulted in the quickest decline in the S&P 500 index in history, shedding a third of its value by March 23rd. But more surprisingly, since then we have been witnessing a market rally that has made the market itself bounce back more than 35%. So I would like to start with you, David. Can you walk us through what was the market sentiment back in February? What did we experience in those volatile days in mid-March? And what is the investor behavior that has led to this recent rally?
Miguel, thank you very much for inviting me to participate on this panel. Well, the experience has certainly been unprecedented, which is a word that is used oftentimes too frequently, but in this case, probably appropriate, because as you indicated, it was a century before when we had the prior pandemic. So what happened as the month of February began to unfold was the virus, which had in January mostly been confined to China, began to seep into the United States, not just as a physical contagion, but also in terms of the earnings implications and the corporate commentary that came. And so during the first week of February, when many US companies were reporting their year-end financial results, you began to hear companies talk about how their supply chains were being disrupted, but it was mostly confined in certain areas. And so it became sequentially more dire as the month progressed. And it really wasn't until the last part of February that it became a recognized event that was going to have enormous financial consequences. We'll put aside the terrible human consequences, but the financial consequences for many companies. And so what happened in extraordinary rapid fashion, it's not just that you referenced the performance of the stock market, but it was what was happening in the underpinnings of the credit markets and in the funding markets. And so that created a dire situation particularly in the commercial paper funding market. So most companies, the lubricant for financial transactions is the commercial paper market in terms of working capital management, in the way that treasurers of companies manage their own internal finances. And so the access to the commercial paper market began to break down. And the most important development from my perspective in the last 3 months was the Federal Reserve coming in, not so much in cutting interest rates to zero, but rather in backstopping the commercial paper market. That was a critical development that took place, if I recall, on the 17th of March. It was a very important development. And then later, about a week later, on the 23rd of March, the Federal Reserve came in with about $2.3 trillion program to back the investment grade bond market. So as you sit back today, from the vantage point, looking back at the worst part of the crisis, at least from a financial perspective, was we were looking into the abyss, into what could have been another depression. And from a risk perspective, what the Federal Reserve did, and subsequently what Congress also helped do, was cut off the proverbial left tail of the outcome. The worst consequences that one could imagine was eliminated or was taken off the table, in the sense that it was solvency, it was liquidity that companies were desperate for, and they was provided. And then the Congress came in and they offered a bridge in terms of a revenue replacement and extended unemployment benefits. So they provided the fiscal stimulus. So essentially the strategy of policymakers here in the United States is to try to bridge both funding markets and the revenue side of corporations and individuals to take them, if you will, to the other side. Now we can debate what exactly that will look like, but ideally sometime by July, the credit markets, companies' revenues, essentially there were no revenues for most companies as everyone was locked down at home in much of the second quarter. There will be no revenues for many companies. I mean, some companies, of course, will have it, but many will not. And so that substitution of that revenue and unemployment benefits has really been essential to allowing the economy to hopefully come through this process. So in response to your question, that was the dire nature of what was taking place in late February as it sort of became more and more clear just how dire a situation it was going to become medically. And then that continued on to the financial markets with its characterizations of what was happening. And ultimately the Fed and Congress were able to put a stop to that domino effect in I think in a very important way. So that's kind of my review, recollection, and analysis of what took place during those difficult weeks.
That's a great intro. Thank you so much, David. And Jean-Pierre, we're very happy that you were able to connect. Thank you very much for joining us. I'm sure our audience has been watching very closely all the GDP data, the unemployment data that has been flowing through all those various forecasts. Various analysts coincide with a global GDP drop of probably 3% for this year versus a long-term average of 3.5%. So unemployment now is the highest since the Great Depression, 14.7%, probably close to 20 if we account for all the other unemployment that is happening that is not recorded. And so it could even rise further, at least temporarily. So I want to turn to Andrew. And we discussed earlier, Andrew, about this big disconnect from what David was just illustrating and this economic data. So why is that so?
Yeah, I mean, that's a question. I mean, I'll even rephrase your question for you, not that you asked, but what's been frustrating to the professional investor population, I think, I'm generalizing a little bit, but is that you have a situation where the fallout from this, we essentially, there was a health concern, don't want to overwhelm the hospitals. So we agreed in unison globally to hit pause on economic activity. The unemployment rate, like you mentioned, is going to be something like double what you saw during the global financial crisis. If you take all the people that filed for unemployment benefits and assume that they make it into the household survey and are part of the unemployment rate, you're going to wipe out more than the entire number of jobs gained during the entire 10-year expansion from 2010 to 2020. And if you look at where the S&P sits now today, off the peak from February 19th, it's only about 10%. So the question is like, you mean to tell me that we're having something worse than a recession. I don't know what else to call it other than a short depression, but it's like, you mean to tell me we have that? And from February to now, the market's off 10%? That can't reconcile. That just doesn't. And so that's the question. There are some clues. Now, I personally side with, we're big fans of what, David at Goldman does. And so I tend to view the market as probably a little bit enthusiastic right now. But I would say, if you start thinking of the market more as a market of stocks and not just a stock market, which is one thing, but it's actually 500 things if you're looking at the S&P, there's more to it than meets the eye. So right off the bat, if you look at technology and healthcare, those are two sectors that now haven't lost money so far year to date. But there's a 25% gap between those sectors and some of the sectors that have struggled, like the financial companies or energy companies. So there's some differentiation going on there. And then if I take that one step further, if I showed you a chart of and plotted the return, like bars, 500 bars, one for every company, and sorted them from, winners to losers, 400 companies in the S&P 500 are down so far this year. There are more than 100 companies that are down 30% or more this year. And people say to me, well, it could take years. It could take 3 years for the airlines or the travel and leisure companies to come back. And it's kind of like, okay, well, United Airlines is down 67%. Well, it could take years for GM to get back to its normal level of vehicle sales. Okay, well, they're down 50%. Well, what if JP Morgan Chase has write-downs because of real estate? Well, it's down 40%. Live Nation's down 50%. So it's not to say that the market completely has a handle on the risks. And I do think there's a certain degree of reopening risk or second wave risk that right now I don't feel the tone of the market is acknowledging. Okay. I think we take it for granted as human beings that we'll figure it out. It'll be fine. But we're talking about a highly contagious virus that could be on the doorknob, and if the wrong thing. So I guess my main point is that it's not just a market that's entirely blind to the economic realities, but it's also a market that, has created a lot of pain and angst. The pain trade has been higher, right? A lot of people are sitting with cash or underweight equities out of prudence and respect for those second wave risks. And they haven't materialized so far. And so the market's kind of left people in the dust. I think that's part of it. I don't know if David would agree, but that's kind of how I'm seeing it. Think of it as a market of stocks, right? Not a stock market.
Do you want to add anything there, David?
Sure, Andrew. I think his points are all valid, and I would just extend them a little bit by talking about the fact that in the index, and we'll use the U.S. equity market as a benchmark for right now, but we could extend that to other markets as well. More than 20% of the index is composed of 5 companies, 5 major, mostly technology and communication services companies. And we all know them, Amazon, Apple, Microsoft, Google, and Facebook. Those 5 companies collectively are 20% of the market. And those companies, those stock prices are all up year to date. And the typical company, to Andrew's point, the other 495 companies, not all of them are down, but they're down certainly worse than the overall cap-weighted index of the market. And so that's an important distinction because portfolio managers have been focused in these stocks for good reason. They have strong growth prospects. They're expected to continue to have those kind of growth prospects. But if you look at the revenue growth and the earnings growth for these companies, they are expected to have revenue growth of roughly 16% over the next 2 years, a compound basis. So kind of 16% each of those 2 years. They trade around 28 times earnings for portfolio managers. That's a sort of 2 times roughly, PE to growth ratio. And the rest of the companies, or the 495 companies in aggregate, have almost no revenue growth expectations in terms of analysts' forecasts, and they're trading around 16 times earnings. So you have this interesting disconnect where you have a 20% of the market is actually in a pretty strong position, stronger balance sheets. They've actually done quite well. When you look as an investor across the market, what is the one characteristic, the single characteristic that defines the best versus the worst performing companies, not in an individual industry, but characteristically or factor, it's the strength of the balance sheet. And so the strong balance sheet companies, I said at the very beginning, the financial implications of this virus are companies losing revenues because everyone's at home. So many companies have no revenues. Therefore, your financial capacity, your balance sheet, your ability to continue to operate as a solvent entity is vital. And so the market has embraced, and appropriately so, the strength of balance sheets as an important characteristic. And if you're a weaker balance sheet company, that is put it in a extremis, in a dire position. That's why the funding markets in the investment grade market, that's why the Federal Reserve has done what it did in terms of policy support. But ultimately, that's the idea of, as Andrew pointed out, the market of stocks as opposed to a singular entity. And this characteristic can be extended into NASDAQ. If you think about the largest growth companies where have stronger balance sheets, generally speaking, faster growth, ability to use digitization and automation. And you contrast that with the smaller cap companies, smaller businesses. If you carry this into Europe, it's the same idea. Balance sheet is the one characteristic globally that investors have embraced as the sort of a defensive posture. But it also reflects to something else that's very important, because it shows that investors, while the market has rallied so strongly, as you pointed out, Miguel, in your earlier comments, the market's rallied strongly, but investors themselves are not that optimistic. Because if the investors were optimistic, then they would be owning value companies. They would be owning more cyclical companies for an economic rebound. They would own companies with weaker balance sheets. Those are the companies that characteristically do well coming out of a downturn. But that's not what people are doing. What they're positioning is owning companies with the strongest balance sheets, the most durable cash flows, the most visible business models with those are the businesses and the stocks that have done well. That is until now. I see more recently, very immediately, you're seeing some recognition that the U.S. states are unlocking the lockdowns are being relaxed. Individuals are going outside. Businesses are opening in some states. And the fact that this could happen, ideally, hopefully, without a spike in the number of cases, would mean that's supportive of economic activity, and therefore some of the more value-oriented companies in financials, in weaker balance sheet companies, more cyclical industrial companies, if those do better, those would do better in that kind of environment. And by the way, that is the lesson that you learn from China, which is in the China, once they were about 2 months ahead of the United States. And I know this is a business school in Mexico, but the experience here in the United States is about 2 months behind that of China. And in China, the industrial part of the economy has come back more swiftly. And it's the consumer behavior that takes time to alter. And so I think that's what we're measuring right now on a day-to-day basis, how that normalization and that restart process works. So anyway, that's kind of what I would add to that.
Those are good insights. Thank you to both. So now I want to move to Jean-Pierre. Your team has spent a lot of time looking at the pandemic data. Let's not forget that this is a problem, a medical problem, a problem more around that part. And how is that? It will be interesting to understand how is that similar. What is happening now is similar to prior pandemics. Can you explain what type of potential scenarios for the pandemic are you looking at? And also, how is this being affected by countries adopting very different approaches to containing the spread of the virus?
Perfect. Can you hear me?
Yes.
Perfect. So probably because I'm very tickled, by some of the other two panelists. So let me quickly answer and put it in perspective. If I sat basically last October and I had told you that One, the consensus of 2020 real GDP growth would plummet from 2% to pretty much -9, -10%. That the unemployment rate would skyrocket from 3.6% to almost 15%. That the consensus would go from 180 in terms of operating EPS for 2020, which means a 10% year-over-year growth, to 129, -20% year-over-year growth. That we would wipe out 10 years of retail sales growth in 1 month, that we would endure the worst monthly plunge in industrial production. The most recent number, -11.2, is basically even worse than the worst months on the Great Depression, that was -9.2%. And that we would lose tens of millions of jobs in a 2-month time span. And I would have told you that we would be higher back in October than we were then. This only makes sense if we experience a very powerful V-shaped recovery, therefore negating all of those basically declines in economic activities and corporate earnings. The market, in effect, is priced as if the COVID pandemic has never happened. And somewhere we may be in denial. So that is my 2 cents. So probably let me try to share one of my screens.
Yeah, please go ahead.
With you. There we go. Can you see it?
Yes, it is there.
Perfect. So in here, what I found this extremely illustrative, and I think it puts into context the question that you asked me. And one thing is, all of the scenarios that we get from the Center of Infectious Diseases and Policy in Harvard, this was published probably 2 months ago. They have 3 scenarios, and in which you see them, they're a bunch of sinus waves with different amplitudes. So if I go from left to right, and I look at the peaks and valleys that we have, there is one scenario where the last wave that we had is going to repeat further into the future. The second scenario is, after this wave that we have, this fall, we may have a wave of amplitudes close to what we had observed in 1917, 1918. And then the third one is what they call the slow burn. And the slow burn, the biggest peak was here, but you still see basically successive peaks. So why do we have the waves? Well, the waves is very interesting because when we engage in social distancing, we do not overwhelm the healthcare system. We stay at home and fewer people get the infection. However, once you have the downward of this wave, you have the quarantines that basically get loosened and people get out. So successful social distancing meant that more people stay at home, do not catch the disease, but whenever we reopen, the virus will spread again, and as it did before the lockdowns. And this is why you see basically this sinus wave. So lacking a vaccine or basically a very effective medical treatment, our pandemic state of mind is going to stay with us probably until well into 2021 and 2022. Now, some countries have adopted very different methods of dealing with the virus. From a perceived delayed response in the US, with a very small percentage of the population being tested, and we're still at the infancy of contact tracing, to what we have observed in certain countries in East Asia, primarily China, Singapore, Korea, Taiwan, the most successful, that have a much more forceful enforcement of quarantines and utilize to identify hotspots and also contact trace very, very rapidly. And I would share this basically, this slide that will give you the different economic impacts in terms of the way that you go about the virus. And focus basically on the dark blue lines. And here is from Google Mobility, the dark blue line is the workforce. So from the status quo, we arrive at the worst, basically, of the quarantines to around minus 55 in the US, minus 65 in South Asia. Europe also hit basically the 60. But what is interesting is to see these three sets of countries, Korea, Singapore, and Taiwan. And here we see the first wave, the little peak downwards. Here we see the second wave. But on average, you did not see economic stoppages as you have seen in the rest of the world to the magnitude that you have seen in the rest of the world. So is it possible for other countries to emulate Korea, Singapore, Taiwan? Maybe, maybe not. So I would probably stop it there and give it back to you, Miguel.
Thank you, Jean-Pierre. Very, very interesting, those graphs you were showing us. And what also are your thoughts on China itself in terms of its recovery? There's a lot of debate of whether they have brought back the economy to a certain level that it's actually comparable to the previous year, or that there's still a lot of room to go. So how real is that recovery? And then a bit of what you were mentioning just now, how can it be replicated? And can we say, well, China is doing fine now, we're going to do fine?
Well, in that case, let me share again the screen. There we go. Let me put this aside. And in here, this was a very simple exercise, and we kind of replicated what the Financial Times had. And we created a very simple index using 6 daily subseries. And this was real estate sales, coal consumption, traffic congestion, box office admissions, container freight, and air pollution. And what we basically see compared to the 100% level of the index in January 1st this year, we're still at 73. So we still have not recovered. Of course, we bounce very significantly on the right-hand side from the bottom. So China is recovering. But for most of what we can know on the ground is not a full-hearted recovery. One, we have supply that has recovered 85–90% in some industries, but we have a problem with demand, and demand is still basically stuck at 65%. The other one that I wanted to share with you, just to make a point, of the indices that are underlying the main index, look at container freight. You were at 100 in January, you're at 69 today. And this is, again, a reflection that not only China has to deal with a weak consumer base domestically, but it has to deal also with a weak export markets. Most of them that are also dealing with quarantines and a reduced consumption. So in here, let me also say in China with a little bit more detail. We move rather rapidly from the lockdown, but if you follow the news, there has been backtracking recent week with some parts in the northeast of China that are under lockdowns as new cases are increased, and massive testing underway again in the former epicenter of Wuhan as we see some other infections emerging during the last month. So now, how can countries emulate basically China? I think that there's very few countries, with the exception probably of Singapore, South Korea, Taiwan, that are in a position to emulate China's achievements in fighting the coronavirus. Even for China, it has been a lot easier to start factory production than to restore demand to levels close to anywhere that they were pre-pandemic. The result has been a growing domestic surpluses of goods and a continued lack of demand as consumers remain cautious. And this, as I said, has been accelerated or exacerbated by the global recession, which has hit import demand. So the combination of weak foreign orders and growing domestic surpluses of goods, well, then it means that the risk of an inventory adjustment led slowdown in production could be significant again later this year. So China will try to preserve stability, whatever it takes to support the economy. As consumer spending is unlikely being the driving force, they are diverting to state-led investment into infrastructure, which will do the heavy lifting. Now, let me conclude with basically, can EMs emulate China, and what are the challenges that they face? One, they lack the same administrative capacity and the health resources as East Asian countries. Two, how to allocate more resources to deal with the high and rising unemployment in order to contain social discontent. As we have seen, there's a lot of private capital that has not, or that is not flowing to emerging markets. So who is going to finance the ever-growing fiscal deficits as emerging market governments try to basically contain and stimulate their economies? How to have access to foreign capital, right? Despite that increasing capital flows and reducing inflows. So without the fiscal headrooms that advanced economies have deployed to support their economies, their banking systems, in the US, if we count both monetary and fiscal stimulus, is to the tune of probably 8.2%, which is absolutely massive. If we bring that to emerging markets, the number would be in probably the 11 to $12 trillion of stimulus. Is that feasible for emerging markets? Probably not. So let me stop there.
Thank you, Jean-Pierre. And you were touching on a very important point around fiscal stimulus. As we know, probably the packages that have been already introduced will account for around 15% of global GDP, which is something definitely unheard of. And in the US, there's still talks, as you know, especially the Democrats pushing for another doubling their own package, which could even reach close to 30% of 2019's GDP. So I want to turn to Andrew. What are the consequences of all these big stimulus and all these debt incurrence that is going to be happening from, for various countries in the long term? And what is this crisis going to mean in terms of globalization, integration, the world order itself?
Well, from a U.S. perspective, it's a little unfair in the sense that the U.S. gets away with murder here. We have the reserve currency of the world, which allows the United States the privilege of doing things with reduced consequences. I'm not, so just real quick, at JP Morgan, we're not terribly concerned about inflation for the next few years. I mean, inflation for the most part comes when there's more demand than the economy's supply side can give. And so the price starts. I always think of concert tickets or tickets to, a football match where you really want to go, and so does everybody else, but there's not enough tickets, so the price goes up. And that happens in economies too. But we just created 20 or 30 million unemployed people who will be able to tap to do the jobs we need to fill supplies. So we have this big gaping hole in the amount of supply available to the economy for a while. So we think inflation is something to regret. We also would remind people that, you don't need to pay down all this debt. If you look at debt to GDP in the United States, it's approaching, you can think of it as World War II levels, call it 100% debt to GDP. But if you look at the cost to service that debt, how much does America have to spend every quarter to pay, whether it's the Fed or China or Japan or so on, their interest that they're owed, that number is substantially lower than it was in the 80s or 90s or any other period where our debt was high. And so we can afford it. We're doing it in the currency that everybody else wants to borrow in. And so now that said, I will just say briefly, I'm not worried about the mechanical consequences of it for the United States in the near term. Other countries aren't going to be as lucky. I do fear that there will be significant political reverberations related to this. And I think a lot of that stems from inequality in our country. And so let me just play this out for a second. In the United States, the Pew Research Center did a study and found that if you are in a white household, 38% of respondents have had somebody in that household lose a job due to COVID, okay? In the United States, if you're a Hispanic household, that number is in the 60% range, 63%. And Black households are somewhere in the middle. And that dichotomy is not new in the United States. You know, let's just be honest. Rich people own stocks and poor people don't. And so in the last 10 years, when the stock market went up 350%, that increased inequality yet again. And so what's happening now is if you look at the inequality in the jobs that were lost during this period, it's only gotten worse. And I don't think it will be unpopular politically to raise taxes on wealthy people or companies to help pay for some of it. And I don't think it matters whether it's Democrats or Republicans. I do think that if it happens, if it's President Trump reelected, I think it'll take longer for taxes to go up, but I do think it'll happen. And if it's, you know, Joe Biden, I think it'll happen more quickly. We could debate the merits of actually raising taxes in the midst of this, the fallout from this crisis, but I'm not sure that the merits are what matters right now. I think politically, you are going to see, you know, some pressure there. And so from a US perspective, those are the consequences. For other countries, and Jean-Pierre was alluding to this somewhat, right now, Latin America has taken the baton from the United States in a bad way, in terms of that's the region that's seeing the most rapid case growth right now. And when you look at some of those countries' ability to borrow and finance these deficits, they don't enjoy the privilege of having the reserve currency of the world like the US. So I think it's going to be a real challenge.
Yeah. No, thank you. Thank you, Andrew. Back to you, David. I want to touch again on the markets, and I'm looking right now at the screen, and we are above 3,000 points on the S&P 500, keeps rising. Do you see more upside or downside going forward? Do you see a path for another bear market? What do you think are going to be the trends in the short term?
Or Miguel, let me, David, if I may, let me ask you it this way. And like, for those of you who don't know, like David's like best in the game, right? So like, I guess the question is that the next 10%, like from here, so we're up 30 something from here, is the next 10% more likely to be some kind of consolidation or pullback, or just it keeps ripping? You know, that's the way we hear it a lot.
I think it's thanks, Andrew. I think it's a great way to characterize the question. And that Miguel, you also asked. My belief is the near term is more down than up. I think the asymmetry of the opportunity is more risk than reward. And the thought process is as follows. Much of the positive news and that expectation that the economy will be able to restart and renormalize is redundant, but just to normalize that process, the market's already assuming that. And here's how it goes in my conversations with clients all over the world, whether in Asia, in Europe, sovereign wealth funds, pension funds, endowments, insurance companies, the hedge fund community, mutual funds, some individuals. The way they think about it is no one is focusing on 2020 earnings. They've all moved forward into 2021. So the whole discussion is about what amount of profits companies will be able to generate in 2021. Now, from an economics point of view, depending on your assumptions, and my colleagues in economics research at Goldman are assuming that the economy in the United States by the end of 2021 will be back at roughly the same size as the economy was at the beginning of this year. So about 2 years in time, the economy will be back. And in a very optimistic assumptions, we also arrive there from an earnings perspective. So that earnings for companies can in fact go down this year. We can debate how bad they will be, but they'll certainly be terrible. And they will come back. And in a very optimistic scenario, that can happen. And of course, it won't be equal in some industries, in technology and healthcare. and probably will come back and even be higher. That is to say, 2021 earnings will be greater than 2019. And other industries in energy, in some of the consumer areas, in some areas in financials, it will be lower level of earnings. So not everyone will participate. So the question then is, in discussions with clients, what kind of valuation are we going to put on those optimistic earnings? We can then some sensitivity around earnings and valuation, because ultimately the direction next 10% higher or lower is a function of, well, what is the earnings, what is the valuation prospect, and then what is the money flow looking like. So from an earnings perspective, pretty much the most optimistic scenario for next year in 2021 will be $170 per share in earnings for the S&P 500, as an example. That's a really optimistic number. Most portfolio managers are assuming on the buy side around $150. So a little lower than we are, meaningfully lower. That means today the market's trading 18 times our optimistic earnings, or almost 20 times forward earnings a year from now. The expectation is the economy will again, in order for that to happen, the economy has to renormalize. It's assuming there's no viral second wave that Jean-Pierre talked about, potential risks. That's assumed not to happen. It's assuming no political uncertainty in terms of the election. It's assuming no trade disputes that get out of hand in terms of disruption, in terms of that steady economic return. And the issue on the corporate earnings. Are companies going to rehire all the employees that have been furloughed? There's been 38 million Americans. Again, I recognize this is a Mexican audience primarily, but there's 38 million Americans who've been put out of work in the last 9 weeks. How many of those individuals will be rehired by their current or previous employer, or will they be able to find new jobs? And so there's economics, there's earnings, there's politics, there's trade, there's all these other risks out there. And to me, those risks seem to be more to the downside in terms of economic activity than the upside. So what is the alternative scenario, or what is the pushback to this? The pushback is there's 150 different medical trials going on now to try to find the antiviral therapy or a vaccine. Only one of them needs to be successful. I mean, ideally multiple will be successful, but there's an asymmetry medically speaking, and this ultimately is a medical issue, that would be to the upside. And then the second would be from a positioning and a money flow. And what is it that clients, how are they positioned? And right now they're somewhere between neutral to slightly less fully invested, shall we say, so that there is a opportunity for more money to move into the market. So in conclusion, when I think about your question that both of you asked in different ways, is the risk more to the upside or the downside? The answer is absolutely to the downside. Right. And 10% would not be shocking in terms of the magnitude of decline. There is some risk to the upside, and I just told you it's really medically driven or money flow, but the fundamentals would say the risk is more to the downside from my perspective.
Thank you, David. Go ahead, Andrew.
If I could, sorry, if I could just restate something that David said that's shocked, that it is hard to wrap your head around sometimes. What we did similar math, David, at JP Morgan. So if you took 2019 in the entire history of America was the peak level of profits ever. Companies made more money in America ever in history in 2019, okay? We assume that the number we penciled in was we think profits will fall by something like 28%, which is a lot more than some people expect. That's a lot. Then we think, so that's 2020. Then in 2021, if you assume there's a nice rebound and they rebound 20% from that lower number, you get to call it 156, 160 bucks. Even if you put a 20, like you said, a 20-time multiple on that, you're back at where we are today. And so just to crystallize that point, the market, based on a generous level of earnings and a generous PE multiple, is at the right price today as where it could or should be in 19 months from now. So you just have to really understand that something has to materialize substantially to the upside. And the other embedded thing that we didn't touch on, but I know is probably on your mind, David, is a lot of people are also saying, well, with interest rates so close to zero, of course people will be willing to pay a little bit of a higher multiple. But you have to remember, everybody, that in an environment where things are recovering enough for the market to get that high in the first place, you'd have to also assume that interest rates can't stay at 0.65%. An environment that improves that much would beget higher interest rates. So something's got to give. And so I sympathize with what David is saying. Right, markets can be irrational for a while, and there's a lot of excitement right now about reopening, but I share your concern that it seems to me that we're bound for some consolidation. Just for what it's worth.
Thank you, Andrew.
Probably not good when JP Morgan and Goldman Sachs agree, but
Thank you, Andrew. So that's a very good segue for a question I want to ask for each of you to answer, if you may. And it's a question that obviously our audience has on top of their minds, which is, what does recovery look like? The Economist talks about a 90% economy. So I would like to start with you, Jean-Pierre. What do you think?
As you know, we're basically not that much inclined to believe the V-shaped recovery. Even though some of our colleagues at the fund are basically hinting a recovery. So let me share one screen. Here, I hope that you can see it. If you see on the left-hand side, this is the April IMF growth outlook. And you can see a V-shaped recovery. However, once you start seeing some of the incoming macro data, the incoming macro data is basically getting weaker and weaker. And even if you note from the New York Fed that is hopelessly optimistic still compared to the St. Louis and the Atlanta, we see a contraction of 9.3% in the third quarter. So what we can say is that this V-shaped recovery is much more going to look like a U. The other point also is, okay, you have partial reopening in some areas. Do you believe that this is going to bring people out basically COVID? We believe that that is not going to happen. And in fact, China points us the way in which we have, in the best of circumstances, the supply side increasing very rapidly, but the demand side still basically playing a catch-up. So this to us is extremely concerning, and is probably going to put the path of the recovery not at the V. And that different path is probably going to have to be digested by the market. So I agree that for me, the path of least resistance from overvalued levels that we're now in most markets is going to be down. But I would point to four things that we need to think about when we look at what is going to happen next. So one is consumer behavior, and consumer behavior is probably going to be modified, but we do not know by how much. So what do I mean by that? I mean by the attitudes that we have towards on the way that we live. Can we expect secular changes in households and company attitudes that may see an increase of home-based work, towards an increased savings, towards increased cash conservation at the consumer level and at the corporate level, particularly at the corporate level, because prior to this crisis, working capital for companies were, at least in the States, you did not have a lot of working capital because you could borrow it very cheaply. So is this attitude towards cash conservation at the household and corporate level also going to influence the way forward? The next is debt aversion. Are people going to be more averse to debt? And the last one is going to be this increase in frugality. So a lot of us have realized that being in confinement, some of the things that we took for granted that we spent on are not that important. So is that going to change? The second one is the political establishment. So We saw in the States, we saw in parts of Latin America, in other parts of the world, population discontent with the quarantines, with the lackluster economy, with mass unemployment and rising inequality are fueling populism, nationalism, protectionist policies. And these could fuel political changes in many countries, particularly in emerging markets. The third one is financial soundness. So after going through this massive hit, cleaning up the balance sheets will take time, both for basically households and corporates. In the short term, that also means because you're less investing, productivity is going to be negatively hit, particularly as you continue these social distancing practices in companies. And the last one, the most important one, I think, is the global implications. And in the global implications, we believe that globalization is set to decline further as supply chains become more localized. And we have heard this onshoring or nearshoring, something that could definitely benefit Mexico. And the supply chains move closer to home, driven by national security concern or more basically frequent geopolitical clashes, here, US and China. And this is already happening in the pharma, in the medical equipment, in the food sectors where governments are imposing restrictions, repatriating production. And the second one is that we have seen monetary policies become increasingly unconventional and far-reaching. I was joking with some of my colleagues, we see debt monetization on steroids. And what is that going to mean? That the initial impact of this crisis is going to be deflationary, but then at one point in time, if we have enough supply destruction, as companies go belly up and so forth, or get acquired, we may have, when demand comes back, a change in inflationary expectation. And I would leave it to there, Miguel.
Thank you, Jean-Pierre. And conscious of time, we have around 5 minutes left to wrap it up, but definitely want to hear the views to complement what Jean-Pierre was saying from David and Andrew.
I'll take a quick stab. I mean, in terms of changes for the future, I think there are a couple of trends that we've been watching, and I know our friends at Goldman have been too, that were in place before the crisis and are going to only become accelerated by the crisis. This was increasingly becoming a digital economy, or at least one where digital enablement has separated winners from losers. And I think that's going to continue and in fact become accelerated. I mean, and just anecdotally, JP Morgan has 174,000 employees that are now registered Zoom users. Before the crisis, the number was none. And, you know, you also saw, telecommunications providers around the world, including Verizon and AT&T in the United States, literally running out of phone line capacity. We couldn't do client conference calls to fit enough people on the calls because Verizon said, well, on Wednesday at 2, we don't have 15,000 lines for you or whatever. And so the rollout of things like 5G, the rollout of things like, the increased use of data storage, cloud computing, cybersecurity. So digital transformation is a trend that is here to stay. It's only going to be accelerated, and there are going to be opportunities there. Healthcare innovation is another thing, and you're talking about everything from genetic therapy research to telemedicine, so you can get care from your home over the computer. And sustainability is another big trend that used to be a nice thing. I care about the environment, so I want to invest with a conscience, but maybe I'm giving something up in terms of profitability. But now I don't see it that way anymore. Now I think that there is massive profitability being driven around consumer preferences for things that work better for the world. And so I think the big trends, aside from the ones that Jean-Pierre mentioned, involve those kinds of things. I agree with him though. Supply chain re-onshoring is going to be a big deal. Stuff like that. So I'll yield the rest of the time to David, who's, I know, does a lot on those themes.
No, I would just continue on. I think Jean-Pierre and Andrew's points are excellent. If there was one word that resonated to me when Andrew was speaking, and it's really a message for students who are participating in this on this webinar, is the word accelerant. And this virus and the response in every country around the world has been less disruptive, in my view, and more accelerating changes that were already in process. And you saw this, or you can really read this, in the quarterly conference calls from 500 different executives during the recent first quarter earnings calls that were held with investors. And those took place basically between the middle of April and the middle of May. And that was the common theme, not the theme, but a theme that was repeated multiple times by different executives in every industry, that it was the digitization, the automation, the direct to consumer, that businesses who maybe this was a nascent part of their business, they had a 3-year plan to grow that part of the business, was accelerating this to try to be done in 60 days and to be able to roll out. So you would order something and then you would go pick it up at the store, where that really hadn't been the case in a size and a scale for some businesses. They may have been a beta testing it in some locations. They had to roll it out immediately. And so those are important developments. So if you think about it from a business point of view, and I always think about it, we have some students here on this call, cash. The business of cash transactions is going to disappear rapidly. It's going to accelerate that process as everyone uses and does transactions remotely. JP Morgan, Goldman Sachs, we're in the banking industry, but that process has accelerated the idea of payments digitally, digitization, and the idea of working from home that Jean-Pierre talked about, and the way that people are going to be realizing that actually can be remarkably efficient. You don't have the commuting, all those issues. And obviously there's a consequence to all this from a job shift in the economy, but I think it really is accelerating these changes that have sort of been in the works and forced everyone to move in hyper speed. And ultimately, I'll just say it is a medical issue. And so the longer that this continues, the more these changes will become embedded in people's lifestyles. To the extent that there's and we certainly hope and pray that there's a vaccine or an antiviral that can be developed as soon as possible. To the extent that there's a medical solution that comes quickly, then there's a chance you revert back to prior behavior. Not totally, but right. Some of those trends tend to come back. If it continues for another year, then they become more embedded. So that would be my thoughts.
Great. Thank you so much, David. And with that, we will be wrapping up our panel and our discussion. So we really thank you, each of you, for joining us. Andrew, David, Jean-Pierre, this has been a great conversation. Hopefully not the first, but not the last one. We'll definitely keep in touch. And I want to remind our audience that we will have another panel on EGADE next Friday. And we also have in the screen a quality assessment, evaluación de calidad. So if people can actually just take on your selections in terms of the quality of this panel and this discussion. Hopefully you have enjoyed the different topics we covered and the interventions. And then with respect to next Friday at the same time, 1 p.m. Mexico time, May 29th, we're going to have la perspectiva del consejo en la recuperación de la empresa. That is, guys, the perspective from the board in terms of the recovery from a company, from a business standpoint. We're going to have Alfonso González, Maria Ariza, Manuel Sama, and Carlos Serrano moderating. So thank you again to everyone. Stay safe and all the best. Thank you.